Well, shares in energy stocks tumbled again today on a warning from Santos that the falling oil price could wipe $1 billion from its cash flows. The price of crude has plunged 30% since July, and there are warnings it may have further to fall. That's more bad news for the federal coffers as well, which are already under stress from lower iron ore and coal prices. Neil Woolridge reports.
It may be welcome relief for motorists, but the plunging oil price has caught even the once mighty OPEC cartel on the hop.
Everybody's agreed that the price is not good at the level of price.
It's not
the
good.
Price is good or the
it's
price
not
is not good?
Everybody's worried about the price.
Venezuela's Rafael Ramirez wants OPEC to cut supply in a bid to get the price of crude above $100 a barrel once again. But the world's biggest oil producer, Saudi Arabia, is refusing.
The extent of the oil price drop that we've seen, and it's come off approximately 30% since its peaks earlier this year, has been a lot more rapid than people expected.
After trading above $100 for most of the past 4 years, the price of Brent crude has fallen by a third since July. The plunge has been blamed on weaker global growth, the strength of the US dollar and the ongoing expansion of US shale oil.
Many of those producers are actually able to continue operating at the current levels, and so I don't think we've seen a very significant supply response yet. So that means that oil prices perhaps could drift somewhat lower than this before, I think, ultimately returning to a higher level.
And that's having an impact on Australian oil and gas producers, with the ASX Energy Index down 16% since September. Santos is now warning investors that annual cash flows could be down by $1 billion because its LNG contract prices are also linked to oil prices. However, energy analyst John Young says that while prices are weaker, the volume of Australian gas sold will continue to rise, especially as energy demand from Asia grows.
The volume from these projects has already been sold. The vast bulk of that has already been sold to customers on long-term contracts. The capital has largely been spent, and these are going to be long-life assets. They're going to run for 30 or more years.
Still, the recent slump in energy prices is another hit to the federal coffers. Falling commodity prices are expected to add at least $2 billion to the budget deficit this financial year and $4 billion in the next. And according to the outgoing Secretary of the Treasury, the transition to non-mining activity is happening slower than anticipated, in part because of the dollar's resilience.
It's quite possible that we'll have years where Australian living standards will fall. And indeed, we've already started seeing that.
In his valedictory speech, Martin Parkinson warned that on current projections, the Australian economy would have grown below trend in 7 out of the 8 years to 2016. And that's already showing up in the rising unemployment rate.
What we want to do is to avoid the risk that cyclical unemployment, that is short-term unemployment, develops into structural unemployment, which would create significant social and economic costs.
And that means Australia can no longer expect to ride to prosperity on the back of an LNG tanker.